making application, the story doesn't have significant meaning. Most of you probably know the story. 3 people worked for a business owner, a substantial, substantive, large asset, large estate business owner. Each one of them were business managers, administrators under the business owner. Morning, Doug. He selected those 3 and gave them assets to invest in the marketplace. This was not the first time they've done business for the master. This would have been practiced of routine for them. Master goes away, they do business, master come back, they report business. He wouldn't have chosen newbies to fit into the parable. So you can assume automatically these 3 have done the business of the master before. There's an understanding of my expectation. That's the first thing. It's not a new hire. Second thing is, master goes away, it's not time to play. When we're not in class, you do the remote assignment. It's not time to play. Master comes back, the expectation is you've done what was expected of you, and hopefully done it with good attitude, done it with exceptionalism, done it with, there's lots of ways to approach things in life. And Paul writes in 1 Corinthians, you can have all the gifts in the world, you can have all the prophecies in the world, you can have all the money in the world, you can give yourself, you can give your body, but if you don't do it with love, it's nothing. You're a noisy gong and a clanging cymbal. So you can do the business of the world, you can do the business of the master and still have a stinky attitude. Just be aware of that. And it doesn't bring honor and please God. So just completing an assignment is not enough. It's always how you approach it. So the master comes back, and the first that had X amount, let's call it 5 or 10, whatever that number is, I don't have it in front of me. 10, 5, and 2, or 10, 5, and 1, something like that. Did the business, returned an investment twofold or threefold, whatever that rate of return was. The master was happy, master was delighted, the master applauded this individual, the master gave kudos publicly, and sent him on his way. The second individual, exact same thing happens. So you have repeated business there. They knew what was expected, they did it well, they did a good job. And here's the contrast. Third person comes back, and they didn't do anything. They were scared or timid or trepid, or they wasted the time, or they forgot to log on to Blackboard, or whatever they did, they just didn't do it. They wasted the opportunity. Now, when you take leadership in the spring, John Maxwell will tell you that the opportunity of a lifetime only lasts during the term limit, the lifetime of the opportunity. Most opportunities have a term limit when they run out and stuff. This individual in this parable did not demonstrate good stewardship, did not obey the master, but it's beyond obedience. You can't even look at it as obedience. Didn't follow his job description. Okay, it's beyond employment obligations. This person didn't take advantage of the opportunity. Now, the master has entrusted this individual with the resources of the business. It's not everybody that is elevated to that level. You'll find when you go to work, it takes you a long time before you rise up in an organization where they entrust you with their resources. Particularly significant resources where they can go away and they know you're going to do a good job. So this person had some level of entrustedness. And so this infraction was a significant infraction. It just wasn't just missing work because you slept in or your dog ate your homework or you had a flat. It wasn't all those excuses. And by the way, those are all just dumb excuses. Let's be honest here. Those are dumb. This person committed a significant infraction against the master. So much so that they were called on the carpet, stripped of all responsibilities, castigated, tossed in jail, weeping and gnashing of teeth. Man, bad things happen. So when you rise in power and then you commit serious infractions, just remember the consequences are equally heightened. The higher you rise in power, the greater the responsibility, the greater the consequences of your infractions. 2 individuals were good stewards, one wasn't. Now Jesus made that point very clear. Now he'll make a spiritual connection, I will in a minute. But let's analyze a little bit further. Not everybody in this business world is not everybody in the marketplace is gonna do good business. There's some people who just wanna ride the coattails of others. There's some people who just wanna skate by. There's some people who just don't wanna be noticed and wanna get a paycheck and move on. Then there's those of you that wanna excel and be achievers. Not everybody wants to be an all-star. Let's just be honest. Some people like to ride the pine. Now, occasionally you wanna start. Maybe some of you really wanna start. Maybe some of you really wanna be an all-star. Maybe some of you really wanna be an MVP. Now, there's a difference between those who pursue their Olympic dreams and those who just play sport. There's a big difference there. Successful stewardship are those who are the all-stars. When we go out and hire people and we instill them in our businesses and install them in opportunities and we empower them, not all of them are gonna rise to be all-stars. Not all of them will be the starter, not all of them will be starters or the team MVP or the league MVP. Jesus knew that. You and I need to know that as business owners. So that's one application there. The second application is this. Jesus looks at the third individual and he says, you know, you could have at least put it in the bank where it would have earned a little bit of interest. So in that little statement, and most of you probably don't catch that, Jesus is affirming the financial systems and the banking systems of the world. He is okay that you store money in financial systems if they earn a little interest back for the master. Now again, there's a greater eternal application and implication. I'll get to that in a minute. But let's understand it from a business perspective. We in business, we learn how to use and leverage our assets so that we can make more assets and resources for our business. And Jesus affirmed that by saying, hey, you could have used the financial systems of the world earn a little bit of interest back for the master. He'd have been okay with that. He may not have been overly, hyperly delighted, but he would have been okay with that. And Jesus said, you didn't even go that far. You buried it, and you laid down underneath the tree, and you fell asleep. Remember when Jesus was praying and the disciples kept falling asleep? He got a little frustrated with them. It's like, can't you at least stay awake? And come on, people. So for those of us, it's time to stay. Don't pray laying on your bed at night because you'll fall asleep. Maybe you need to sit up, stand up. There's other ways to pray that will prevent you from falling asleep. Laying around the tree, burying your talent. It's probably not going to be good stewardship and good investing. Now the eternal principle is really quite simple. God has given us internal, intrinsic talents. And it is use of money. It is use of knowledge and skills and abilities. There's lots of talents. We can go into the spiritual gifts and ministries of the Spirit. We could look at natural talents and trades and those kind of things. Whatever those things God has gifted you in, the expectation is that you and I invest them into the kingdom for Him. So in the end, I must live for Him. That's why I'm here. If I do, He'll richly reward me. He's honored by it. We do want to bring glory and honor to the Father. Remember in Hebrews, it's either 11 or 12, that it is faith that makes the Lord tickled. It is faith that makes the Lord excited. It's faith, when we demonstrate our faith, that's what really brings glory and honor to God. And so let us use our talents wisely for Him. Even while we're here playing sports and studying, using your talents to benefit the King and the kingdom always puts us in a better light. Now, all of us want to rise up in organizations and want to make more money. You want to have promotions. You want to get paid more. How do you do that? You're good stewards of whatever level you're at and whatever you got going on. And then people like me will notice you, and then you'll get more. And you'll get more. So it's real simple. He rewarded the two that exemplified and demonstrated healthy management, financial management, good business. And he consequenced the third. There will always be people in our businesses surrounding you. They will be all-stars and performers. There will also be those that don't live up to the expectations, and there'll be consequence. So the truth is, which one are you going to be? Which one of each one are you going to be? That's the application. You're going to be one or the other, so which one? I would say, Doug, where you at? Choose wisely, please. Jake, choose wisely. Which one are you going to be? Exactly right. Let's go forward in prayer and we'll get started. So, Father God, we just thank you for bringing us together today. Lord, help us to grab what it is you're showing us and telling us. Internalize it, Lord, and Lord, plant those seeds deep in the harvest field of our heart. Make us great financial stewards and men and women who can do this stuff well and well for you with faith, investing ourselves, going the extra mile for you, Lord, because we want your kingdom to shine. We want your light to be so bright that everybody sees it, and truth to rise up and tamp down misinformation and disinformation. Lord, we pray that your communication resides. Lord, make us good financial managers and stewards and coaches and ministry people. All the while, grow us in grace and knowledge of the Lord. We love you, Jesus. In your name we pray. Amen. So I just want to do a little terminology reflection, and this terminology is more application. So when I introduce terms, it is so that you get comfortable with them. It is so that you can begin to flow with them. So although I give you sheets on things, and I think you could print it out, or there's one in module 1 in Blackboard, you could have looked at it. I've gone over some of them twice. I just want to make a couple of greater applications, and then we'll bounce over to supply and demand. But it is good that we learn about personal finance constantly, because personal and professional finance are really kind of interwoven. So I've talked about fiat currency, and I've talked about various forms of money. Money is something that has real intrinsic value. It often has utility. So you can buy a piece of real estate and it has a utility value. You can build a house on it, you can stay there, you can build a business on it, you can create activity, you can hire people. So now you're employing, you're enterprising, you create new products into the marketplace, you're assisting the marketplace, you're generating profit, you're generating tax dollars. So that utility of that real estate's being utilized constantly. We look at assets. Those are things that we own that have value, or things that we want to acquire that have value. And I talked a little bit about value, and I think I want to re-energize that a little bit, or blow that balloon back up. And so when we're talking about assets that are items that I personally hold, or you personally hold, or assets that the business personally hold, let's understand that assets are always have a value to some degree. And I think it's important for you and I to understand where the value is derived from, because when you understand the valuing of an asset, as a business owner, it is always my goal and responsibility to increase the value of my business, increase the value of my assets, increase the value of whatever it is we have and we do, we're generating, we're producing. And that, the accounting term is appreciation, which is it's really a financial accounting term. It is my goal as a business manager or a business owner to always increase the value of my business and my production, the value of my products, the value that people give. And so if you've ever heard of value-laden business, that is that there's tremendous value built into it. Well, and we'll talk about this in the next section when we get into why people buy professional sport properties. But the truth is that rich people around the world like to buy professional sport properties. They like to buy a big major league franchise because there is great appreciable value built in them. We have seen over 2 decades that a football team that was valued at $100 million will go to $200 and $300 and $400 million within the course of 10 years. And if you're an owner and you can take $100 million and actually multiply and double or triple it, then that's a really good investment. Well, that has been happening constantly in the marketplace, which is why the rich people, and I don't want to use the word globalist, but the rich elitists around the world look at the sport industry and look at professional sport franchises as a viable investment vehicle. And so although the Mark Cubans of the world, they like to play and be on TV and say awkward things and whatever and draw innocuous spotlight, the truth is he bought the Dallas Mavericks at a low price. It has appreciated in value. There's a number of things that do that, but his investment is accruing and appreciating in value. And that's the real reason why he did it, and he holds on to it. And so many others have done that for years. It is our goal as financial managers to make sure that whatever assets are within my purview, whatever I have control or influence over, that they grow in value. The first house you buy, you should buy it at a low price and work real hard to improve the value, because one day you will sell it. And you always want to sell it for more than what you bought it for. And the difference between the buy and the sell, the beta, and the word beta is often referred to as difference, hopefully is in the positive. Hopefully it'll be and increase viable. So when I bought the house we live in now, it was in 2009, it was valued at 176.5, and I have spent significant amount of time adding on an in-law suite and redoing bathrooms and fenced in the backyard, and I've added an orchard in the back and did some other things up front. And recently, when I had it reappraised to refinance in February, it came in at $380,000. So it has grown not quite threefold since the time I purchased it, but I remember talking to the appraiser in January when he came and did a visit, and one of the things that we referred to is that the level of investment into improving the property is always realized at the appraisal. And so you always want to do things to make your house better, your business better, your employees better, because the appreciable value, the growth, is most valuable to you. Now, hence I refinanced and got a really good lower rate and all that. But it continues to remind me that we as business owners, you as asset owners, always want to be working to improve the overall value of your asset. Now, we like to buy stocks, and the reason why we buy stocks is not so we can watch them just float on the water. We want stocks to go up in value. So whether you're buying trusts or mutual funds or there's all kinds of funds out there, but just use the word funds or stocks as liquid assets or liquid equity. When I'm buying equities, when somebody's buying into the NYSE or the NASDAQ or the Amex, those are the stock markets, and you're buying an individual fund, which is a grouping of stocks, or you're buying one individual stock, you're always doing so recognizing and hoping that its value goes up. Nobody buys stock so it's flat. Nobody buys stock so it ever goes down. The anticipation and expectation is that it always appreciates in value. So my goal is to see it increase in value. Now, what drives a stock up is a lot different than what drives a piece of real estate up or a business. So there's differences there. And so you need to understand the valuation system. So valuation is how something's valued. So certain assets in the marketplace have a real value to it, a real value. Other assets in the marketplace have a assigned value, and that's probably one of the greatest differentiators is some are considered real valued assets and others are considered assigned valued assets. And so the property that I owned, when it was appraised at $380,000, that value was assigned by appraiser. It was assigned value. And it's actually only worth $380,000 if I can sell it for $380,000 and I can actually close it and recoup that $380,000. So what you find then is assigned value and real value levels of appreciation or depreciation can only be realized when there is actually a transaction that occurs. And so when I have a transaction that occurs, price discovery happens. And so that's a phrase you want to get familiar with is that if Connor and I agree, Connor's going to buy my house from me, and we reach an agreement that it's going to be $360,000, even though it's appraised for $380,000, that's assigned value, the real value happens at the point of transaction, and that transaction is realized when he transfers $360,000 to my account, and then I turn over title or deed to the property to him. So then the new real value is $360,000. Even though an appraiser came and said it could be worth up to $380,000, that's only assigned value based on variables. So let's apply that in a couple other instances. I showed you baseball cards or football cards that are graded, stamps, coins, whatever. There's lots of collectibles. I have an Arrowhead collection that's pretty nice. Those, you can list those on eBay. You can go on eBay and look at lots of things you want to bid on or want to buy. And the truth is, the real value of those is only realized when price discovery occurs at the point such time as you either sell or buy and the transaction happens. And so you may think that that item is worth, I've got a Hank Aaron that I'm getting ready to list, and I think it's worth about $2,100. Realistically, I'm thinking I can probably only get about $1,500 for it. So where I think it's valued, it's assigned value, and where I think we're going to settle on a real value at price discovery are two different things. And you have to recognize that sometimes our expectations and aspirations don't always line up with reality. The reality is something's not worth anything until you pay for it or somebody else buys it from you at that price. And so if you make widgets or whatever it is in your business, they're only worth what somebody will pay you for them. And so you might have an expectation, or you might have some aspirations that the thing you're producing is really worth something. It's only worth something if somebody pays for it. And at that point in time, price discovery occurs, and that's when real value is realized. Other than that, it's just assigned value. So the government says this bill that I have is worth $1. And it's only worth $1 until I go in the marketplace and invest or spend it. And so, I don't have any dollar bills on me. So the retailer can say, well, that used to be worth $1, but now it's depreciated down to 50 cents, and it's gonna take 2 of those to buy the same candy bar, whereas 10 years ago, it only took 1 of those to buy that candy bar, or whatever the item is. And so, even though it says 1 on it, the marketplace can actually reset the value by depreciating products or appreciating. Remember, I talked about shrinkflation. They're putting less cereal and more air in the bags, making the boxes bigger, and they're making the air. You know, there's all kinds of things they're doing. But the truth is, those gimmicks are all done in such a way as to take that $1, which is a 1 on it, which is assigned by the government, and actually lowering or raising its value within the sphere of the marketplace. Now that's fascinating, is that you can have something that is assigned one value, but it has a realized value that's either lower or higher when you actually transition or transact in the marketplace. And that's where inflation and deflation comes in, is that the stock might be worth $40, but when you bought it, it dropped down to 39, and then when you sold it, it quickly went up to 44, but it might settle, its 1 year average might settle at 40 on a continuous basis. So again, assets can have fluctuating values. They can have values that are greatly assigned, and they can have values that are greatly realized, and those differences can be, the beta can be huge. And so I know that about the marketplace. So I never pay the price for anything that I see what's known as list price. You have to realize that list price is always inflated on everything in this world. It's just the concept of inflation. If you go to Dr. Boulet's office right now, or Mr. Entrikin's, and sit down and ask them to tell you about inflation in the marketplace, they could talk to you probably for a week about it. And once you realize that, and you're a financial steward with your own personal assets and the assets of others, you quickly realize that all price points, with some exceptions, are generally inflated, and the marketplace realizes that unless you negotiate it, they're gonna get what they want. Well, you shouldn't ever let the marketplace win in that scenario. You should always negotiate your fair market value for your hard-earned dollars or the dollars of your business or whatever it is. Because we all know that there's a scarcity of dollars. Now that's a term I've used before and you want to get familiar with, but no business has an open checkbook. No business has an unlimited amount of resources available to invest in the things. We all have to be good stewards. It requires us to be good steward managers. And so there are fewer and fewer dollars available, or scarcity of items. There are fewer and fewer items that I need available. Remember, we go back to the bartering. If I need this and you don't have it, there's a scarcity in our relationship for that particular item. And because there's a scarcity, it often drives both value and cost up. So we do understand and realize that. But just recognize that prices in the marketplace are generally always inflated, and they don't have to be realized until you negotiate a settlement where where you come in and make that purchase. And then what you have is price discovery. And so, with few exceptions, I negotiate most price points for most things in my life, personally, and the couple of businesses I'm involved in. And then with my church, I negotiate those heavily, so that the church is not taken advantage of, but it gets a good deal. The truth is, the church is a business Monday through Friday, and if we do our business real well on Monday through Friday, then we get to really do church well on Sunday. And that's just an acronym we use, it's not the only one. One of the things I've taught my pastors is the church is so much more than a business, so much more. But if we operate any less than a business, we'll go out of business, and I can't afford to pay any of them. And so none of them like that. They're like, oh, we like to get our paychecks. Well, okay, well then we gotta do good business, and then we go from there. So it's more than a business, but we can't be any less than a business. And that's the case with any nonprofit in the world today. So the difference between the price that you pay for something and the assigned value can be greatly different. That beta can be large, that beta can be real small. Most of the time, there needs to be some difference. You have to become a good negotiator, a good buyer, a good seller for your business in order to do well. Remember, most of us will have some sales experiences. Most of us will do some buying and asset management for your businesses. And if you can demonstrate an ability to negotiate with you know, in a loving manner, there's a great way to negotiate, and you don't have to be mean to people or hard on people. You don't have to be really hateful toward people. I negotiate very peacefully, and generally, the Bible tells us that, you know, if you use honey, you're going to attract more than if you use vinegar, and there's a proverb on that. And so always use honey in all those situations. So I entreat people in the marketplace really well, and generally then I get favor from that. And then out of that, the organizations that I represent, they're benefited. And that's the kind of negotiator you want to become. That's again the good steward who knows how to do business for the master and knows how to do business in the marketplace. And so we recognize there's scarcity of resources. We recognize that neither we have surplus of resources, nor does the rest of the world. You don't have to look very far, and the world is hurting right now. There's droughts in the world, there's fires in the world, there's famines in the world. I was reading just last week that there's water shortages in several places of the world. Not the standard places where they have a hard time finding water, but there's actually water shortages in major regions where they grow tons of food, and that's why we're seeing an escalation in the food prices, and that's why you're seeing a decline in the overall value and the overall supply. So the supply chain has been disrupted by droughts and fires that affect massive food providers for the world. So, and if you realize that, then you realize the cost of those are going to go up. As somebody who has 5 in his household, and my mother-in-law used to live with us, it was 6. That's a lot of mouths to feed on a regular basis, so I was always watching the food prices. Real value, surplus, depreciation, appreciation, those are great terms to live by. When you get into chapter 1 in the textbook, there's a couple of things I really want you to look for. The first one is the saturated marketplace, and I'll finish with this one, and then I'll go into supply and demand. But as you're reading through chapter 1, the saturated marketplace is really an interesting kind of a dilemma for us in the sport industry. And it occurred in the 1980s and 1990s when sport really began to blossom, and we were on TV all the time. We had this advancements of cable television where all this sport product was being put out on all these cable television networks. And so back in the 90s, they just basically started hundreds of cable networks around the world, and they would fill basically the product would be sport that filled the network time slots. They were selling advertisements to commercial advertisers like crazy, and what you had is this explosion of minor and major league sport from the 80s into the 90s, and that caused us to renovate all these stadiums, arenas, convention centers, and build lots of new ones, and then add the new technologies in there. And all of a sudden we had this plethora of sport, and sport became entertainment then. So we had a plethora of sport and entertainment around the world, and we quickly realized by the turn of the 21st century that sport was becoming more of an entertainment provider and less of an athletic provider. And so we were doing things in order to produce sport to satisfy the TV audience, the radio audience, and the virtual audiences. So what we did is we bent sport to be more entertainment, and it had great production value and great production orientation. And so then by doing that, we moved sport to sport entertainment, classic, a term that Vince McMahon has used so many times. But when we became sport entertainment, we moved out of an athletic arena and moved into the entertainment arena. And the entertainment space was already occupied by dozens and dozens of entertainment providers, whether it be Disney or your Regal Cinemas or any number of other providers that basically do entertainment for the public. And so the notion of a saturated marketplace is that we took ourselves through the advancements of sport, and we moved us from just being an athletic provider to an entertainment provider. And when we became an entertainment provider, we actually moved over into the entertainment industry where there was already a very full plate of entertainment providers. And so then what happened was that made us the overflow of the entertainment industry, and the marketplace got very saturated with entertainment providers. And so then we will see, and we'll talk about this and we'll get to sections 2 and 3, or modules 2 and 3, is that we've seen in the last 15 or 20 years that attendance to professional sport, attendance to college sport, and even the ratings on TV have been going down and down and down in a lot of instances, not all of them, but a lot of them. And the reason is the marketplace is oversaturated, not just with sport, but the sheer fact that there's just too much entertainment out there, and there's so many options that people can choose from, is that we cannibalize the options by providing too much and then moving into entertainment. And it has really hurt us in doing so. So some advancements, and that's one example, and you can read about it in the textbook, but some advancements in industry, and that one in sport actually ended up hurting us, and we've still been trying to make those adjustments from that. So you'll still see a lot of forms of entertainment in the sport venue. If you go to the football game Saturday night, there's lots of forms of entertainment that are built into the production of a football game. And so what happens is it becomes as much about the intervening things that go on in and around the stadium as it does the actual play on the field. And I know all of us like sport and want to play on the field, but the truth is we've moved the visual from the field into the stands and the sounds and the lights and all that to make it more of an entertainment option and less of an athletic option. So really it's a hybrid between the two. And so the marketplace is saturated. We're losing consumers. Because of that, they have so many entertainment choices that they can walk away from sport and still meet their entertainment needs in other ways. We'll talk about it more as we venture on, but that's a particular section that I think you need to familiarize yourself with. I know there'll be probably a short answer question on that. And so I've written about it as sections that I find that are premium, and I will not only address them in class, ask you to read them, but I'll write about them myself. So I believe in Blackboard, if you go into Module 1, don't do it right now, but go into Module 1, and there is, again, I've listed the videos and I put that stuff in there, but there is a monetary system terminology page or two that I put in there. And I think on the last page, I've done a couple of paragraphs on the saturated marketplace and one or two other things that I'm going to pick up on. So when I write about those, I try to provide to you specifically what is important to me, and if it's important to me, it should be important to you. I want to move into supply and demand while we have time left. And we're going to video this last section, is that right, Connor? Yes, sir. Good. So just want to make everybody aware of that. Let me go ahead and set this up for us. It's an economic concept, supply and demand, has great financial applications and implications. The harvest is ready, labors are few. When there's few laborers, that's limited supply. And when there's a bountiful of harvest fields available to those laborers, well, there's a lot of supply of opportunity, but limited supply of laborers. So in God's kingdom, when he said that, he was identifying that there's demand in his kingdom for people to step up and be laborers. The laborers are few. So when you have few of an item, few of a product, it means there's great need for it. And a need can always be met by supply. So people that start businesses, they look around the marketplace and they say, okay, where's the need that I can meet? And they see that there's few suppliers, there's limited producers, limited production, and so maybe I can fill that gap and get a percentage of that market share and make a lot of money doing it. So entrepreneurial and enterprising individuals look for supply-demand issues in marketplaces, in industries, and they try to fill that gap and be a supplier who can supply and capture a percentage of that market share of that industry or of whatever that is, that product or service, and then they make a lot of money from it. And so enterprising and entrepreneurial people very much lean on and rely on and understand supply and demand and the applications in the industry. So I'm gonna give you some basics on this, talk through it, make some sporting examples. The law of demand, we'll start with that one. That's probably the easier one of the two. And when price of an item goes up or goes down, in this instance down, the demand goes up. So when price declines, interest inclines. When price declines, you're more interested because you can afford it or you can afford more of it. So then the interest grows, the purchase grows, and then demand for that is actually cultivated because of a declining price. So people can now afford to buy something that they couldn't previously afford. Their interests are more willing to purchase because we're dollar conscious, we're monetarily minded. We've got limited supply of dollars in my business, in my household. I know there's a scarcity that I live within, and so we're watching for price points to go down. There's certain things that I won't ever buy unless the price goes down. In the marketplace, if you buy stocks and equities, the old adage is buy low, sell high. So you're waiting for price to go down. So in this instance, understanding that when price of an item goes down, more people will buy it. And when you're a company and you want to sell stock to generate equity to do something, lower stock points can help generate volumes of sales. And so then a company can use that cash infusion or that cash to be able to do whatever it is that they're anticipating doing. Also, if the price drops enough, people tend to hoard. People will buy more of the product. Sometimes we see alternate uses, sometimes we want to hoard it, sometimes you want to stack it, sometimes you're buying because you know price is going to rebound back up and you want to, if you're buying this particular item every 3 months, 6 months, 9 months, 12 months, you might as well go ahead and buy two for the price of one because you know the price is going to go back up and it may never come down. So in business, sometimes we buy more inventory or we buy more supply because we know the price of supply fluctuates, and usually purchasers are looking at fluctuation in prices over year, and they know when it reaches a certain price, I should buy more volume, or I should sell more volume or sell less volume. So again, those of us in business that are very conscious of this are watching for these things. When equities go down, I'm watching a stock, and when I see it dip down to $4, I'll buy a bunch of it, and see it go up to $6, I'll sell a bunch of it. But when it hovers at $5, I don't. I'm not gonna play with it because I know there's a beta there that I wanna buy and sell, and the difference there is the ROI, my return on investment. When price goes down, we like to buy. Sometimes we buy a lot more, sometimes we store it, and sometimes it's simply because I can now afford it. And we celebrate that. Law of demand. There's a relationship between price and the amount, that's quantity of a product, and my desired determination to buy. And that relationship is strong, positive, but it is an inverse relationship or an indirect relationship. As price goes down, interest goes up. As price goes down, the volume of purchases go up. As price goes down, the level of watchers goes up. So you list something on eBay and you list it too high and nobody watches it. You lower the price on it, and then next thing you know, you got 150 people watching it and 300 views. And it's really fun to do that, and you get to quickly see the application of supply and demand because you can see how price, the psychosis or psychology of price, greatly affects people. It's an inverse relationship, and the word inverse means it's contrasting, it's opposite. I'm sure all of us would like to own a Lexus or a BMW X5 or 6 or 7 or whatever the latest. I'm sure all of us would like to own the latest Apple phone or whatever. But we all realize that the price of that is probably price prohibitive. It means most of us probably can't afford that. But if the price on that item came down and came down significantly, probably a lot more of us would start watching it, and eventually some of us would start buying it. You know, so one of the reasons why I don't drive a BMW is because just I don't want to pay that much. But if BMWs came down $20,000 or $30,000, I probably would buy one. So it's relevantly, completely oriented around price. And there's a lot of goods in the marketplace that you simply buy or don't buy because of price. And secondarily, because there's so many other alternatives out there available to us. So if I was to build this is just a real simple demand table. I need to get you accustomed to looking at tables and graphs and numbers, and that'll help you in your financial understandings. But this is just a 2-column table, and let me see, price on the left, can't see very well through the shield, and the number of balls that are sold on the right. And so at a price point of $4, this particular company sold 200 balls, let's say across a given week, so we give it a time frame. And then a week later, they lowered the price to $3, and all of a sudden, they sold 290 balls that given week. So they continued on the trend and lowered it to $2 and sold 380 balls that week, and then they lowered it to $1 and sold 430 balls that week. Now, there's a lot of analysis you can do. What was the cost of a ball, and then, you know, where's their break-even point? At what point did it become saturated and it was worthless? You know, was it a reoccurring price purchase, or was it all one lump sum, or was it sold individually? There's lots of things you can derive out of that, you know. But what we see here in this particular instance is when this business reconciled by lowering price on more than one occasion, they saw an increase in sales, and it was directly correlated with the lowering of price. And so when you're in business, what we do in business is sometimes we tinker with our price points. And we might do it, depending upon how frequent you sell. If you're a baseball game and you're having games every day, it's easy to tinker with your prices on a regular basis to see, you know, where you'll best land. If you're a business that sells on a bi-weekly or a monthly or a semi-annual or annual basis, you don't have the same volume of ability to make those adjustments. But certainly a business that sells balls frequently can play with that. But we're always looking to determine where we're going to get the most bang out of our balls. Now, what you could do is you could multiply those out and say, well, if we sold $430 balls at $1, we generated $430 in sales here, but 380 times 2 is $760 in sales, and 29 times 3 is 29, 58, 78, 87, $870, and then $800. So my greatest return on investment would have been the 290 balls at $3, which was, if I did my math right, $870 worth of revenue for the company. And so if you're looking at gross income, which one of the 4 points made the most during the week, you'd say the $3 price point where we sold 290, something like that. And so then that's a great way to determine whether or not you've done well, just to draw that out for you. And that's what the question asked you here. We'll probably do some tables like this. These will be simple, and we'll start with some simple tables, and then we'll add some pieces to them. I think it's important that we become good financial analysts to become good stewards. So you have to look at some limited data and say, okay, yeah, that makes sense. If I multiply those out, yeah, okay, the best price point, the greatest revenue has to be right here. And so the boss comes to you and says, good job, Doug or Jake,
We like the $3 price point, and your trial run over the last 4 weeks has helped us determine that we're going to set the price for the next 6 months at $3. Take the day off, and here's the credit card, go have fun, I'll see you in 2 days. You know, so those kind of things, we do that in business all the time, is that we're trying to figure out where the best price point is that generates gross revenue, that generates sales, but also generates a return on investment. Now, you cannot have return on investment until you know what the cost is going in. If my cost for the balls was $3, it would be zero return on investment. And the only discovery would be at $4, then, and it'd be a loss at $2 or $1. So you have to know what, based on volume, what your cost going in is, and then you would actually subtract that out, and then you would really know not only what was my gross revenue, what was my net, and my net was what I made after the cost of doing the business. Enough of that. If we were to take that and place that on a curvilinear graph, a demand curve might look something like this. As the price declined, sold more balls. And so you can see, now this graph is not, sometimes when people would ascribe a line that goes down as a bad thing. No, it's not a bad thing. So as we lowered the price, we sold a greater quantity of that. And so properly interpreting that, as you could say, well, you know, again, where's my best gross? Well, my best gross was right here when you apply dollar figures. But if it's your goal just to sell more balls no matter what the price point is, well then yeah, you're gonna be here at the lower price point. So again, it depends on what the goal is. We can make some simple assertions looking at the data or the graph itself. And so again, I want you to become comfortable. We'll do some graphs in Excel toward the end of the semester with some table data, and that'll help you begin to process some of this. So it's one thing to learn information, the second thing to apply it, the third thing is to then use it. And by us working in Excel with some graphs and tables, you're taking information that you've learned, you're comprehending it, you're applying it, and then you can solve some problems. It's my goal to help you become a better problem solver. It's not enough, Nolan, just to know terms, or Josiah, just to comprehend topics or concepts. You have to be able to apply it, and then you have to be able to use it and use it well. So interpretive analysis, taking the information, look at some tables, look at some graphs, drawing some proper conclusions out of it, is we will work toward that point at the end of the semester. Let's stay where we are. So that was law of demand. Now that was the easier one too. Law of supply can be a little more confounding for all of us. And so it's not the opposite. And so I want to tell you right away, it is not the opposite of law of demand. And a lot of people will misassign it. So there's a relationship between the quantity that the seller wants to sell over some time period and the price we want to sell it at. And that relationship there is the law of supply and the supply curve. So this particular economic indicator comes from the perspective that me, the producer, I have a desire to sell a certain amount of product for a certain price. And we're gonna look and see what affects or influences those. So, though usually the relationship is positive, usually, so when the price increases in this instance, so does the quantity supplied. There are a few exceptions. That's why it doesn't parallel or directly, antithetically contrast law of demand. So law of demand is really more of what the consumers or the producers are looking at from a point of price, knowing that lowering price increases demand. But in this instance, our business as the producers and sellers, we have a certain price point we're at a start at, and we have a certain level of product we'd like to sell at that price point. So my goal is not just to lower price to sell more and more and more. My goal is to create value at this price point. And so I can buy a used vehicle for $2,000 or $3,000 or $4,000, and hey, I got a vehicle that runs and it fit my price point. Or I can go buy a Lexus at $80,000, and I know it's one of the best vehicles out there, I'm gonna get 20 years out of it, and it's gonna be top of the line, I can rely on it. So therefore, I'm willing to pay $80,000 because there's tremendous value in the vehicle. If I buy a $4,000 truck or car today that's got 180,000 miles on it, it's gonna need a timing belt, and the tires are worn out, it's gonna have issues, transmission's gonna go bad in a short time period, and I'm just uncertain about that. So one perspective is I can look at the cheap automobile because simply I can't afford anymore. And that's understandable. A lot of us operate at that level, totally get it, I do as well. But when you are a producer of an item that has tremendous value, if you are a producer of an item, let's say you're the producer of the Super Bowl, and if you've ever looked at the cost of tickets to go to the Super Bowl, Super Bowl tickets are $1,000, $2,000, $3,000, $5,000 a piece for a ticket. You wanna go to a Jaguars game, a preseason game, you can probably get in for 25 or 30 bucks. Now, what's the difference there? The difference is that the Super Bowl is the premium. It's the last game, the best game, the most important game, it's the most watched game, there's a premium on that versus a Jaguar preseason game. So when we have high-valued, value-laden products or services, events, informations, we have a certain price and a certain volume that I wanna sell. So if I'm the host of the Super Bowl and I've got 70,000 seats, and no one of them is gonna go any less than $1,000, I have a premium product, I have a limited amount of supply, and I have a price point that I'm coming in, and it's pretty high. And so that's the zip code where this law of supply plays. So it's not just the opposite. It's not that people are demanding more tickets, therefore I can supply more tickets. It's that I realize that I have a premium product and I'm going to sell them at a premium price. And if you don't get it now, actually price is gonna go up. So you'll hear that language used a lot. Better get it now while time lasts. And then I sell out. And then, oh, I found some more tickets. So instead of $1,000 a pop, now they're 2,000. Hey, we found another 1,000 tickets in the end zone for the Super Bowl. Didn't know they were available, but this time they're 2,000 tickets instead of 1,000. And I sell all those. Oh, we just found another 500 tickets at the 30-yard line, but you know, they're going fast. It's 3,000 for this grouping. And so you'll see that strategy used by maybe a little unethical, because it is a little deceptive, but it is a sales strategy, and I'm not necessarily recommending it, but we recognize it, we understand it, and we need to know when it's being used on us. So a supply table, as pricing declines, we decide to offer and offer more. So we start selling our jerseys at $14, and I sell 200, and I only made 200, and they flew off the shelves quickly. So I know that there's a premium on them, I know this is a high quality jersey, and I know my end game is to go higher. So we're gonna produce another batch of these jerseys, and we're actually gonna increase the price to 23. And we created demand by putting a tight lid premium on it, and we sold 290 at $23, and we did it again at $32, and we did it again at $41. And so for businesses that can leverage their brand and the quality laden value of their assets, they can use the law of supply to their advantage to generate more gross income. And in the end, the bottom line, the net income. And that's what we all want. We all want to make more money. I mean, I'm not gonna kid you, that's what every business owner wants. And it may not be their top priority, it may not be their bottom priority, but it is a priority for every business owner, and most general managers and business managers want to sell product and make money. And if we don't sell product, we don't make money, we can't pay ourselves, we can't pay our employees, we don't get to have the things we want to have or don't get the things we wanna do. And so the truth is, I go into business to make money. It's not the only reason I'm there, and it's not the lasting reason I'm there, but it is a stable. And so now we understand that for those businesses that have a premium product, World Series, Super Bowl, the Olympics, lots of things that have a premium price attached to it, then they have an ability to sell and leverage the asset at a premium price, and then sometimes use the law of supply where they limit the supply. I'll send out this batch, and then I'll release another batch for a little higher, and I can see that sells quickly. So instead of just flooding the market with just a gazillion Super Bowl tickets, I just let out 1,000 at a time, and 1,000 more, and 1,000 more, and I can keep escalating that price because the demand across the people is cultivated by that. So you can go to the grocery store today and all of you can buy a box of cereal for $3. But if they only had 5 boxes in there and you all rushed and they sold just like that, and then the supermarket would tell you, well, if you come back tomorrow, we'll have 5 more. Those that didn't get it are all gonna rush back tomorrow and they're gonna see the price is doubled, but they're still gonna sell that 5. So there's ways to create demand by the way we limit the flow of supply. It's like turning the spigot on and off. You can limit that flow or increase that flow, and you control the demand. Now, that it doesn't work with every product, and it doesn't work in every business, so there are other internal characteristics. But if you understand just the basic premise, we can launch from that. Now, I like to talk a little bit about the economies of the marketplace. I do believe that Dr. Boulay or Mr. Entrican have mentioned it on more than one occasion, but we have what's called market systems in the marketplace. And the market system is how we do our business, how people make decisions, what they buy, what they don't buy. So there is a psychology to purchase and a psychology to price. We'll actually talk about that a couple of times this semester. You'll feel like you're in general psychology class, but it's a fascinating discussion about the psychosis of price or the psychology of value. And again, we have to understand that because that kind of stuff influences, even philosophical understandings influences my purchases and my sales. So we're going to look at the market systems, and market systems are more than just doing business buy sell. There's feelings and emotions that goes into people's purchases. There's emotional capital that people express. Just a lot of things that go into buy and sell and what we do and how we do it and how we get there. Rather than just the mechanics. If all it was just teaching you the mechanics of money management, which we have to do, but that's not enough. You've got to understand the why and not just the how behind that to be that good steward for the master. And one point I'll make often in this semester as it relates to scarcity, there is no business in any industry that has an open checkbook and an unlimited supply of money. There is no business that has an unlimited supply of resources. Ever. So we're always after more. And that's not greed, let's understand. If you can sell 50, why not sell 100? That's not a bad thing. If you can sell 100, why not try 200? That's not a bad thing. We're meeting the needs of the consumers in the marketplace. And we're not going to carry volumes of inventory just to flood ourselves. So it's not a bad thing to want to do more business or sell more. We want to fill the stands Saturday night at the football game. We don't want a seat open. We want people standing at the top of the rails on both sides of the aisle. We want to play in front of packed houses. So you really want us selling every seat and then some. Well, that's the nature of business. Nobody likes to play in an empty stadium. We all like to play in front of a loud, raucous, packed stadium. And I invite you all to come Saturday night. I think I sent you an email, the athletics department now looking for volunteers to work the games. And for some of your classes, you're required to do X number of events. I don't think in this particular class you are, but you can certainly volunteer and continue to get more game day experience. Sign up for the football game. I'll be there, I'm the scoreboard operator, and I have been for a long time. I've worked up in the press box doing statistics and then scoreboard operations for about 15 years now, going all the way back to 2003 or 4 with them, something like that. We don't have open checkbooks, there's tremendous scarcity. Now, don't write every word down, these PowerPoints are actually in Blackboard, but as long as you get the key concepts. And the challenge for us as financial managers is to, as I wrote it here, and I can't see clearly, so I'm gonna go over here, is that we face the allocation of revenues among all the competing uses. Now, that goes back to the saturation notion that I mentioned earlier. People have money, but they only have a certain amount of money. And if we're entertainment providers, the sport industry, they're gonna choose on how they best spend their entertainment dollars. We hope to attract them to choose us, but let's understand that there's lots of choices available to them. You know, when I grew up in the 1970s, there were only 3 national TV stations, ABC, NBC, and CBS. It was, in Ohio, it was 3, 5, and 8 were the channels. I used to turn that big dial. And then there was a couple of cable channels locally, and that was it, regional channels. So everybody watched the Monday Night Football, and then everybody watched, so during the week, everybody watched the same thing. They were very prominent. We didn't have a gazillion options, but with the advent of satellite and cable and all the virtual entertainment we provide, now you have 9 gazillion options. And when you provide so many options, that's called cannibalizing. When you provide so many options, you take the supply of people and you spread them over all those options, and then what happens is everything declines. And that's why TV ratings and attendance to major professional sport properties have been declining over the past 2 decades. Now, that's not healthy, but we do have to understand that we've got to make adjustments. And actually, if you look at the new stadiums that are being built today, they're actually downsizing stadiums and arenas and convention centers. So for 25 or 30 years, we were building these massive entertainment venues. Now we're actually downsizing them to accommodate for smaller attendance, and we're building more luxury boxes and luxury suites. I'll talk about all that sport for the rich. That's going to be a lot of fun. Scarcity, let's stay on target. People want many things in life. They want a lot. And it is an interesting study of if you look at Maslow's needs of hierarchy, the goal of self-actualization at the top, but when you start on the bottom rung, the physical needs, the felt needs of an individual, I need food, I need water, I need shelter, I need clothing, basic sustenance to survive, and I'll fight like an animal to keep those, the survival of the fittest, goes back to Darwinism. But because there is scarcity in the marketplace, we will go to great lengths to acquire that which we need. So when a desire is then fulfilled, if I get what I need, this is just human psychology here, then what happens is another desire arises up and take its place. Desires are always infinite. The supply of stuff is not. There is not enough resources in the world to supply everyone's need continuously, unless you turn to the King, who's the supplier, as your Jehovah Jireh. The word Jireh, if you look that up in the Hebrew, he is my provider. He supplies the eternal needs that I long for intrinsically inside of me. Now, that's different than the extrinsic things we're talking about here. But in the context of scarcity, there's a limited supply of resources in the world, and so we will go to great lengths to acquire them. If I'm a seller of them, then I can command or demand price. If sport businesses had an open checkbook, there wouldn't be any problems. All the problems of the world would be solved. Okay, are there any questions about anything that I've covered this morning? I would be studying. I think you have an examination coming up sometime in the next week or 10 days. Go back to that schedule. Once we get through that exam, then we launch into the study of sport and college athletics, and then eventually sport and professional athletics.